Hey everyone, welcome to the Walk to Wealth podcast. If you're tuning in on YouTube or any of the podcast directories, I just ask you one teeny tiny little favor. If you find any value in this episode or find any value in the episodes prior, make sure to subscribe and to follow us for sure so we can keep on bringing amazing guests like the one we have today. James, for anyone that may not know you, tell us your elevator pitch. Who are you? What do you do?
Yeah, definitely. So thanks for having me on. I really do appreciate it, John. And what I do is I run a wealth management firm, and we focus on building family offices for those that don't have $250 million of investable assets. So we do everything from soup to nuts, from building a financial plan, doing investments, finding insurance opportunities, and then definitely tax planning. Great partnerships with some CPAs that help do the preparation for us too.
Amazing. And so, James, tell us a little bit about your walk to wealth. Where did this journey begin? Where did it all take place before you got to where you're at now and all the success that you've been able to achieve?
Yeah, so it's been an interesting way of doing this. I feel like I do everything the hard way. So the way I did it is actually started from a futures and commodities class in college, where I was in engineering before, was not a fan of it, moved to international economics and finance, where I got my degree. And the conversation became, hey, do you want to take econometrics or futures and commodities? No, I haven't idea what econometrics is. That sounds boring. So I took this ag class that was futures and commodities trading. So I went to school, Texas Tech. It was literally cotton farmers over my class. And I ended up getting a knack for this day trading thing. And I was like, you know what? Let's do this. Let's see what happens career wise and go from the oil field, which I originally planned on going into after college, to the finance world. And as soon as I did, I fell in love with it. So I worked at a large dealer in multiple roles, with various roles. It learned kind of everything from the back end, how the operational side of the business runs. And one day it just hit me. I fell in love with being an advisor. And so I did a pivot in my career and just went full throttle into it. I read everything you can ever imagine, worked too long, and got all my licenses out of the way within about 2 years. And here we are today, where I realized, hey, let's go build a firm that makes more sense in a way that I believe it should be ran, with deep relationships, not trying to be a transactional business.
Yeah.
And so we're off to the races we are starting beginning of this year.
Yeah, amazing. So tell us a little bit about your upbringing. What was money like in your household? What was the conversation around money? Was it something that was scarce? Was it like when you were growing up? Like what kind of money mindsets, beliefs that were kind of instilled in you early on? And did those serve you? Were those something that you had to like break free from and overcome in your later years? So tell us a little bit about that.
Yeah, that's an interesting one. So my mom was a private banker when that just started at Chase. And she basically just kind of worked with all these extremely high net worth individuals. So the concept of a dollar just was always there. I always knew kind of, you put money in, you put money out. If more money comes out than you're putting in, something's wrong. And so my mom literally made me balance checkbooks when I first got my first job. I hated it. I still hate it to this day. I can't tell you how much I can't stand it. So it was always, I understood kind of a little bit how money worked. And I was always interested in this. We did like a class, I think it was on junior achievement, maybe 7th or 8th grade, or picking stocks. I was like, oh, this is kind of fun. I like this, because I had no idea what it was doing. But you pick one, it goes up, you feel good. You pick one, it goes down, you feel bad. I was like, this is interesting. And then as soon as I turned 15, my parents were like, hey, go get a job, go pay for gas, go pay for your car, what have you. So I immediately started working. And that's when I kind of started to realize, 1, I hate taxes. 2, I hate taxes on overtime, because I'd work a bunch of overtime for no money and then be really frustrated because then you see how much the taxes take out of the overtime. So that's kind of how I'm started. I've been working since I was 15 and I've kind of learned how that operated. That's kind of my foundation of this whole money mindset. And then, as I was telling you, I kind of remembered my parents, because we always get like allowance from on the lawn or whatever. And it was never a lot. But I remember I wanted to buy remember X-Men, like the old school X-Men cartoon?
Yeah.
So I wanted to buy like a Wolverine Jeep. And I remember I only had, let's say, I don't know, $10 and it cost $12. And I didn't have anything to do with it. I remember being so upset. I remember saving that cash for the next time for Toys R Us when that was still around, and actually bought that Jeep. So kind of always kind of had a rough understanding of it. Nothing too crazy that I'm aware of.
Yeah. I'm kind of curious. What was it like in college? Kind of like just switching entirely what you want to do from originally pursuing the oil industry, you said, to getting into just from one class, just jumping ship and getting into the the finance world and the markets and the day trading side of things. What was that kind of like navigating that as a college student? As you know, a lot of young people tend to have that shiny object syndrome and tend to lose
Yeah.
focus there, or they might not even know what they really want to be focused on, but you kind of knew instantly, like, hey, I want to get into this. What was that kind of like navigating that situation in that environment where a lot of people are just thinking about partying and you had something bigger on your mind?
Oh, don't get me wrong. I was partying too.
Yeah.
So I was doing engineering. I was doing all the classes, and I was doing like Cal 3 and differential equations, and physics 2, like all these like really tough classes. I was like, I kind of hate this. I wasn't liking it. And I was fortunate that I knew some people that were in engineering a few years above me and also working. And I was like, hey, this is what we're doing in school. Is this what it's like? And you're working, and you go, oh, absolutely. Like tech is like one of the better engineering schools for this. And I went, okay, I definitely don't want to do this. So interestingly enough, I actually applied to Texas Tech at the time, had the only personal financial planning class and degree in the country. And they said, hey, your GPA is 0.01 below, go kick rocks. So I was pretty frustrated. I was like, well, okay, let's see what I can do. So I started looking around. I saw international economics and finance. I'm like, that's interesting. This sounds cool. And I took to it like a duck like the water. I mean, I picked it up immediately, fell in love with it. And that's where that kind of that futures and commodities class came in. And I was like, oh, there's something here. I was kind of scratching a certain itch that I found that I was looking for. And I'll be honest, I think I was very lucky and fortunate. And then it gets to the point where I was taking so many classes to catch up that I put too much on my plate and actually failed that class the first time I took it. Failed it big time. I had no idea because I wasn't really paying attention to it. So my last semester of school, I had to take, I think it was like 3 classes. It was a whole ordeal. Focus on the class and focus heavily on it and really paid attention. And that's when I said, okay, there's something to this. It's a different way of thinking and working, making your money work for you. And so I think that's kind of planted the seed to where we are today.
Yeah. And one last quick question before we get into today's conversation. You said that you didn't meet the GPA requirement to get in, and then you ended up taking some more classes. And because you were overloaded, you ended up failing a class and you had to take it again. Why don't you think that you didn't just quit right then and there? You had the opportunity to do so. You got told no twice and you kept pushing through. What kind of helped you persevere through that to make it to the other side so that you can get into this?
Why do all that work for nothing? Honestly, there's a great motivational video. I wish I could remember. I think it was by, his nickname's like the hip hop preacher. I can't think of what.
E.T.
That's it. E.T. I love E.T. Yeah. There's a great video with him. And he goes, and I'll never forget this. He goes, don't cry to quit, cry to win. You already pain gets your reward from it. I'll never forget that. And it sucked. And I looked around and I think it helped that I had friends that were saying like, quitting was literally never an option. It was not even a thought. It was just, yeah, you're going to do this. Suck it up, get it done. And I think that mentality, at the end of the day, it's the perseverance that truly matters. Because if I'm looking to hire somebody in my firm, I don't care what your GPA is. I don't care. Are you going to work your ass off? Or if you're going to be in the sales side of the business, are you going to sell your ass off? Are you going to get after it? Because that's what matters. And you read every self-help book, it comes down to discipline and action. That's it. That's the secret. So I think that's what it was. That's why I couldn't quit, just had to get through it. And I spent 5 years in Lubbock, Texas, and I didn't want to go back for another year. So I was kind of ready to go.
Yeah, no, definitely. And so through all your experiences as a financial planner, you've been able to come up with the 4 horsemen, right? To financial planning that people need to stay away from and kind of be aware of so that they don't get themselves into big financial myth like mayhem in the future. So where does that begin? How can we start preparing so that we don't have to worry about the 4 horsemen coming over and kicking us over and declaring bankruptcy and all this other stuff?
Yeah, so let's talk about that. So let's first label the 4 horsemen. And I would love to take credit for this name, but my mentor that we talked about earlier, Brian Jackson, he came up with this. He calls them the 4 horsemen of financial planning. Kind of like it because it's the voice of doom a little bit, just to help you kind of get rid of these major gaps. So the first of the 4 horsemen, it's in this order of priority, is emergency savings. So 3 to 6 months emergency savings. And from there, it's eliminating credit card debt. Or I'm kind of on the fence about this, or protecting your income is also 2 and 3. Those 2 can be flipped. So if you have a lot of credit card debt, that's number 2. If you have very little to none, then that's number 3. Then from there, it's protecting your income. So for example, if you're a single payer household, let's say you're married, dual income, and you have kids, whoever is working, more than likely their disability insurance is not going to cover your expenses. So you need to actually protect yourself a little bit. And then from there, starting to save from retirement. Because if you're not doing it in that order, you're going to end up always leaking money at the back end. For example, if you have credit cards, let's say 22 to 27% interest rate, no matter how good of a investor I think I am, I can't guarantee to beat that every single month. I just can't. So let's pay that off first and then start building wealth that way.
Yeah, so let's start up from the top, right? Emergency savings. We live in a country where I think, what's the stat? Like I think like 70%, something like that, of Americans can't afford a $500 emergency expense.
Yep.
I made a YouTube short literally a couple of days ago from the day we're recording this. And there's some guy, the quote was like, he was talking about my guest, Chris, he's on episode 40. He was talking about that he uses a bank called Ally Bank, which is another bank that I use personally that I love. And they have buckets. And in those buckets, he has like emergency fund where he saves. And he made an example of every time you go to the car dealership to get your car worked on, it's always whatever you had originally came in there for. And then they come up with a couple other things that also need to get fixed. And whatever you expect to pay, you end up paying more. But because he has that emergency fund, he's okay. And then some guy commented like, oh, must be nice for you guys because to have like dispensable income or something like that. And just like victim mentality, BS. So what advice do you give to people so that they can start saving, so that they can be adequately prepared for whatever may come in the future, whether that's a car that they have to fix or maybe a roof, or maybe they just want to there's just a rainy day, how can people start preparing for that?
Yeah. So let's talk about that. So if you have an emergency savings account, I always going to tell folks this. It's not the one emergency that's really going to get you into a death spiral. It's the two emergencies that happen kind of back to back. Like, hey, you got to have to pay a major repair in your car. And then let's say driving back, you get a pretty bad wreck. Well, and you can't work. Let's even just add that onto. So I live in Dallas. Dallas drivers are notoriously terrible, especially the past few years. Seems like it's gotten a little worse, but they're bad. So you get a car fixed. You're okay. I got like a month left, but I'm getting a wreck. Well, now what? Now I'm hurt. Now I can't work. And people think, oh, that can't happen to me. It happens all the time. My dad got sideswiped, rear-ended, and flipped around facing the opposite direction, facing traffic. The dude's a great driver. There's idiots out there. So when we think about that, when I hear, oh, it must be nice. Okay, well, what are you spending your money on? Do you have the newest iPhone? Are you living in the best places? Are you going out to eat every day? How much money are you spending on alcohol and booze? You have to be very honest with yourself. I think you have to be willing to make that sacrifice because it is hard to get out of that rat race and that trap. How much money are you spending on Hulu? Do you have roommates? Are you spending, oh, I want to live with anyone else? Okay. You may not be able to afford not to live with anybody else. So this is what I did. I'll tell everyone what I did. So when I moved up here to DFW, so I got an apartment, couldn't afford it. And I was lucky and I had guys that I worked with that were living with their parents at the time and said, hey, you know what? We want to rent a house together. Are you interested? I was like, absolutely. I'm going to save so much money in rent. I did that for about 4 years and had roommates after college. I was like, hey, this is what it is. But that allowed me to save up cash for a down payment on a house, pay for the car, to pay for everything else. Because if not, who knows? And let me save more for retirement. So you got to be able to make a sacrifice at some point in your life. No, it's not always easy, not having the newest, brightest things. You have people literally in lab coats doing everything they can to make your eyeballs and your attention and whatever dollar you have left, spend it on them, not someone else. So it's a hard game to beat. That's why we've got the 4 Horsemen. 3 to 6 months emergency savings. If you're single or you're the only person working, minimum of 6 months. And it's hard to do at first. But once you get in the habit of it, what you'll end up seeing is that there's this weird behavior that happens where you go, okay, I'm saving money. I can pull a dollar. The account value is kind of cool. Let's put a little more in there, put a little more in there. Next thing, you don't want to spend that money. It's a weird little trick our brains do. And so that's kind of what you got to really think about. Where's your money going? So that dirty word budgeting, I like to call it a spending plan. Where's your money going? Figure that out, Dave. And you'll be surprised. Figuring out will get you.
So then let me ask you, what are some other things? You mentioned sharing an apartment with a couple friends to save on rent. What are some other areas or places or ways that people can use to start cutting back on their expenses and so that they can start saving some more money?
Definitely. So I think it's a twofold thing. So it's a twofold strategy. This is what I did was at the end of the day, you can only cut your expenses down to zero. However, you continue to learn, and there's tons of free ways to learn online now to where you can always increase your income as well. So if you do the both together, where you keep looking for that next best job to give you that higher pay, so that's going to help one, because that's ultimately there is no limit to the top, but there's always going to be a limit to the bottom. And then we start eliminating expenses. See where you're spending your money. Are you paying for all the streaming services? Get rid of them. Or get one, share them with some friends. I do that still. Like, I pay for all of them. Share streaming services. Where are you spending? Are you going out to eat a lot? You go out to eat a day, a month, weekly. Like, where's your money going? And then where are you spending it? So I always call device call. Hey, I have no shame in that. And so I'll go buy bourbon and go, oh, wait, I'm spending a little too much here. I got to dial it back somewhere else. So where does that go? I'll do that too. Like, hey, we're not going to drink. So we just did sober October. Okay. Just don't drink for the month. Do things like that. Find where your money is going and find where you're leaking it and minimize it. So rent is always a tough one. Electricity, especially now with all the inflation issues we're having, is pretty tough too. So it's really hard to suffer a little bit with that. Raising your apartment or your house is 78 degrees. That's not fun. But where else are you spending money on? Are you buying things at the grocery store? Are you using all the coupons you can? I've been doing that recently just to cut down on costs for groceries. It's crazy. So I've been using lots of coupons. And it's a good way to keep it down. But really the goal is to increase your income and minimize expenses.
Yeah, definitely. And so let's get into the next part is the credit cards, right? And a lot of people have mixed reviews. I know Dave Ramsey hates it. I know a lot of other people talk about, I'm for credit cards. I like the point to miles game. What are your thoughts on credit cards? And then let's get into how we could start getting out of the credit card debt if we're in that debt. So what's your thoughts on credit cards first?
Definitely. So I love credit cards, right? I'm the same way. And I love the way Dave Ramsey works. I don't always agree with things with them, but his deal is very simple. And it's not the worst thing. If you have a credit card and you can't help it, always keep spending that dollar amount, there's more at play than just finance. There's more behavioral, psychological issues there that we need to figure out and uncover. But overall, credit cards are great. There's credit cards like a 2% cash back. You can put money saved for retirement in there. That's pretty cool to do anything. So, overall, credit cards as a tool, love them.
Yeah. And so then let me ask you really quickly, because before we get into tackling the debt, some of the best things you can do to protect your personal finance is preventative, right? Make sure you never get into it in the first place. So what are some tips you can kind of give there so that, we can take advantage of the 2% cash back without finding ourselves at the end of the month only paying the minimum that compounds over 1 to maybe 6 months. And then next year we only paid the minimum and now we have this large balance. So what are some strategies that you could, or advice you would give so that we could kind of take that more preventative approach so that we don't get into the debt?
Absolutely. Track your spending. So remember earlier when I was talking about how I hate doing balancing the checkbook. The reason why I hate doing it is because I see how much money I'm spending too at times. So if you don't, I don't even know if banks even give those out anymore, but if you don't have that, there's a handful of ways to do it. So remember, track your spending. If you use Excel, if you're real good at Excel, you can use that. That's a great tool. I have lots of clients that use that. You can use integrated software. There's tons of them out there. Like candidly, I use Money Guide Pro. It's my entire financial planning tool and it has an integration that tracks my spending for me and my clients. So I use that. And I go pull it up because one of the tricks that I learned when I was working with these family office folks at a substantially high level was that they always, sorry, my printer started going off randomly. That was weird. One of the things I learned with these family office folks is no matter how large the income that they had was, they always knew where their dollar was going. And I'm talking down to like $5. I remember the guy was frustrated over, I think like a $7 dividend. And he was worth $250 million. It wasn't even a rounding error for him, but he knew where it was. So he always knew where his money was going. That's a big one. And there's tons of ways to do it, like without giving out.
Let me ask you a quick question that came to mind. Do you think that gets to people? Like as you said, he was worth $250 million. $7 isn't going to hurt him anywhere. You think that kind of eats away at your mind after a certain point in time?
I think it's his mentality. So his mentality is to save and invest every dollar. He's a very good investor that put a lot of money in over time. So it's more of a mentality and a mindset. Because if we think about the behavioral side of everything that we're talking about, it is, I'm going to sacrifice today for more tomorrow. And in fact, there's a study that they did with kids. I think this was done probably in the early 80s. They said, hey, you have an Oreo in front of you right now. You want to eat this Oreo, you can, but if you wait 5 minutes, we'll give you 3 Oreos. You wait 10 minutes, we're going to give you 15 Oreos. And what they found was that the kids that waited longer, that had more of that self-control and discipline, those are the kids that end up having a much more successful financial life. Because that was for a reason. They're taught that, it's how they are. That's ingrained into them.
Yeah. Okay. So to get back on track a little bit, as you mentioned earlier, right? It's not the one tragedy that happens in our life that screws us over. It's I got to pay my rent this month, and then next thing, boom, car accident, and then my car is totaled, so I have to fix that. But I'm also can't work because I just broke my leg, and then also I have another bill next week, right? And then the spiral just goes tumbling downwards, right? So some of us end up getting a credit card, whether it's for bad spending habits or it's for back-to-back tragedies that we have to somehow pay for on a card. How can we start working our way out of that debt so we can get back to zero? Because as you mentioned, credit card debt is horrific. Those rates are absurdly high. So how can we get out of debt once we find ourselves in there?
So there's a handful of ways to do it. This is where Dave Ramsey and I cannot agree more. So I love how he does the snowball effect. I think it's brilliant. So there's 2 ways to tackle it, where we can say from a logical point of view, we can do the math and say, hey, debt A will take longer to pay off, but it's going to save you, let's say, $10,000 more. Or debt B will take you a lot shorter to pay off. It's going to cost you more money overall. However, it's going to trigger that snowball where it feels good. There is a lot of dopamine in our brains to pay off the debt. And so you can do that. And there's also times you can look at credit consolidation. I've never seen a time where it made sense to do that, to be honest with you. It may be out there, it may not be. I just honestly don't know. And you do that same thing for your student loan debt, because no matter what this administration said, that's not going to be paid off. It's just, I just don't see it happening. So you got to do that as well. No one's going to come and give it to you, by the way. No one's going to come and save you from your debt. You got to do it yourself, because the credit card companies, that's how they make their money, is those high interest payments. Same thing with the student loan debt too. That's how we're paying off debt across the country, is through those interest payments. So you got to pay it off yourself.
Yeah. And so now that we're kind of finding our way out of our debt, right? The next step you said is to protect our income. What do you mean by that? A lot of the viewers, as right now at least, are single. The college students have left school, so and trying to understand that protect your income thing doesn't really make too much sense at first. Thought, like, do I grab a shield and protect me from my job? Like, how would someone go about protecting their income, so that they don't have to worry about losing money or things of that nature?
Yeah, that's actually a great analogy. So I use the sword and shield analogy a lot. That's a great one. And so the disability, this is literally disability insurance, is what comes through is you're protecting yourself against the work. And depending on where you work, so a lot of times you work for a large corporation, they're going to give you $50,000 disability income protection for free. The reason why it's $50,000 is anything above that, depending if they pay it or you pay it, there's a taxable that happens. So 95% of corporations, they say, hey, here's $50,000 to cover you. And by the way, you're not going to wait 6 months, because we don't want to incentivize people to not work. That's bad for the economy. So $50,000 is generally what you're going to get. Depending on where you work, you may have enough saved up. You may not. That's why we have that 6-month window. And then all of a sudden you're starting to run out of money, get the credit cards to cover your expenses. So that protecting your income is huge. And in fact, let's say those that are listening are going to be the next CEO of wherever we're working. You'd be very surprised that generally those folks don't want disability insurance the most, because they have very high incomes or very high expenses, but they don't have a lot of liquidity. So that's part of it too. So that's why I kind of say that's a good part of it too. Both working, you're both in pretty safe jobs. Is it needed? Depends on your situation. But if it's single income, 2 people are working or 2 people are married and one's not, it's a good time to use it.
Yeah, and so then let me ask you, because a lot of times, like people my age, they start off at jobs like Home Depot, Walmart, Target, things of that nature. So very big companies, but they usually start off at the very bottom of the totem pole. And a lot of time, things like that aren't usually brought up in an interview, not because it's not available to them, but because it's like one of those, how would you know what questions to ask if you don't know, right, what's available? And so it's like you don't know what you don't know type of thing. So it's like when these people are getting these jobs and usually these starter jobs, how do they bring that up in conversation so that they can figure out how to use this? Is that available to them? How can they bring that up so it may be accessible to them and things like that?
Yeah. So if you're working like a starter job, so I'll tell you a good story. So I was lifeguarding, crushed my big toe because of an umbrella weight. That was a lot of fun. Lots of blood squirting everywhere. Lots of crying for me and other people out there. It was pretty bad. And all of a sudden I was like, okay, I can't work. Well, because it happened on the job, workers' comp, these large companies that you're working for, you're going to be fine. If you look at the benefits package, you'll say workers' compensation is included. If you get hurt on the job, and definitely don't about getting hurt on the job because you will be investigated. The emergency investigates everything that happened. They're going to call witnesses. It happens. And insurance fraud's a huge issue. If you do that, you're probably going to jail. So don't do that. They may, at these larger organizations like the Home Depots, the Lowe's, et cetera, may have an option to buy additional disability insurance. It's kind of going to be in your benefit plan. The mom and pop shops may not. So that's kind of where you need to kind of pay attention to that. And every case is, of course, going to be different. Now, if you're younger as well and you're living with your parents, it's not really going to be a priority, right? Because your parents, you're going to have your necessary expenses. They're paying for the mortgage or rent. They might be paying for food. So it's not necessarily needed as well, especially when you're younger and you're on your parents' insurance.
So let me ask you another question then. What advice would you give to the entrepreneurs, to the small business owners that kind of have their own thing going and they have it up and running, but as it's like with the small business owner, usually you're wearing so many hats that the minutia, I guess, kind of gets lost. And so, but as you said, especially more so with being an entrepreneur and a small business owner, you're running everything. So you are the business. So if you lose, you get injured, you're definitely screwed because it's not like you're in a big corporation that has the benefits plan to help you with the workers' comp. Is there anything that entrepreneurs and small business owners could do so that they can kind of be protected in the case that they may get injured or hurt?
Yeah, so it's something that we do. So your disability insurance, I can cover you. And there's different layers to disability insurance as well. So for example, the cheaper it is, the more jobs you can work. So let's use me as an example. So I run the firm, and let's say I lose my hand in an accident using a chainsaw. This weekend, I'm going to go cut down trees in my parents' house. So let's say I lose my hand. Hope that doesn't happen. But if I do, my disability insurance, let's say today, says it's called any occupation. So that means I can go work at McDonald's and still take orders. So skill sets and everything, you just can't do it. A better example is actually a surgeon. I'll use them as an example, a surgeon. So because they still have the other use of their hand, they can go work at McDonald's. Disabilities not cover. There's another one called own occupation. So if you're working in a very niche, very highly skilled technical environment, you're going to pay more for that, but that means that it's going to cover you to protect your current expenses. As well as there's tons of continuity, types of insurances and protections and contingency plans you can put together for a firm, especially if you're wearing the one hat, because it is tough. You are the firm. So that's a big gap that actually we see a lot with these small firms because there's no one there to back you up. It's not by fault. It's just the nature of it, design.
Yeah. And so as an entrepreneur, who would you go to reach out to get that disability insurance? So you call up Geico or whoever has your auto insurance plan, or who would you reach out to get that disability insurance?
So I want to be careful how I say this. Google's a great friend. You can always Google where to get disability insurance from. Find someone like and trust. Like in my company, we do all the insurances outside of home and auto. So for my clients, I just say, hey, here's your 3 options because I don't care which carrier it goes to. I just care who's the best for my client.
Yeah.
So there's multiple ways to do it. Google is probably your best friend on that. Or if you know somebody, it always helps. And then make sure he's the right type of disability insurance for you too. And that's really where the insurance guy needs to come in and find what he can trust.
Yeah, already perfect. And so we talked about, getting that emergency fund, getting out of that credit card debt, protecting our income, making sure we're good just in case, God forbid, but any of us get hurt, we're safe and we can still maintain paying the bills and paying what we got to pay. And now planning for retirement, it's something that a lot of people tend to skip out on. A lot of people forget the story of the magic penny, right? They think like, oh, I don't have too
Yeah.
much money now, so I'd just rather not invest until I have X amount of dollars. I want to start making this much money, I'll start investing, not realizing if they started now, it'll be benefit them in the long run, not only because of the compound interest, but because of building the discipline and the habit of investing in general and starting small. So what's your advice on planning for retirement, starting investing now? Where could people, the younger generation, get started investing so that hopefully they can have the opportunity to retire earlier on? And if they want to keep on working, it's because they're loving what they're doing, not because they have to wait until 65 to get their access to their Roth or their 401k or their pension plan or whatever it may be.
Yeah. So this is near and dear to my heart. I always love working with younger folks when it comes to this. So the earlier you can save for retirement, the better. And if you say, oh, I'm going to do it next year, or I'm going to do it next year, you could be costing yourself hundreds of thousands of dollars. I know that sounds insane. Here, I'll even do some math. We'll do some quick math on the fly. So this is my baby right here. It's a financial calculator. Use it all the time. And so basically we're going to do like a time value of money calculation. And let's say we're going to put in, well, I don't know where we can be 18 or I'll say 15 years old, because now what's really cool is they have kids Roth IRAs. Those
Yeah.
exist even a handful of years ago. I love them. I think they're great. So let's say you're 15 years old and you're retire at 67. That's the full retirement age. So let's just do some math real quick. So that's 52 years. Let's say you put it in the S&P 500, average 8% or so. And you put in $6,000 with no reinvest dividends, just $6,000. And then payment of zero, you're going to put anything in. That's going to be $328,000 by the time you retire. Pretty cool number, right? But let's say you wait until you're 30. I'm going to be 30 years old and start saving. Same amount of money, but let's just see what that looks like. So that's going to be 37 years, 8%. So we're kind of going through this right now with you, just to kind of prove a point, right? Press the right buttons. That's only $103,000. So just those handful of years cost you $200,000. Now expand that number to dollar cost averaging, keep putting money and keep contributing. It makes a substantial difference. And even just a little bit of dollars today, there's now so many accounts that you can start with like $10. That's the way to do it. And you just keep putting it in and keep putting in, getting the habit of that. And next thing you look back 2 years down the road, okay, that's kind of cool. 4 years down the road, oh, that's cool. Or 5, 10, 15 years down the road. And all of a sudden you realize you're ahead of your peers by a wide and substantial margin.
Yeah. And so I think the stat that most people don't have a neutral net worth but until the time they reach 30, because they spend so much time trying to get out of college debt. And then by the time they start working on that, they end up getting a mortgage. So if you have a net worth of zero at this age, you're ahead of people for the next 10 years or so, right? Because most people don't get a zero net worth until they're in their 30s, when they finally hopefully pay off their mortgage or decide to pay off their student loans or whatever. And so then let me ask you, because especially for me, I'm one of the guys that fire people, right? The financially independent, retire early. What advice would you give to people like us that, don't want to wait until that traditional retirement age to start investing, or to retire and stop working? And it's like, we want to get it done sooner. We're a little more impatient. We're go, highly driven entrepreneurs that want to get it going now. Would you give the same advice there, or is it the advice you would give slightly different?
Yes. So kind of a little bit of both. So if you're going to do fire, I used to work with a lady who was doing this, and it's very fascinating. She worked about 70 to 80 hours a week, pretty intense. She had no social life. She had a very large retirement plan, very savvy how she had it set up. And she retired during the COVID pandemic. And she ended up working again because she was bored, because she had that mentality of doing that. So if you're going to do fire, there's a handful of gaps that really truly need to be solved for. So 1, what's your goal date? 2, let's say 40, right? If they retire at 40, you have 27 years of paying for your own health insurance. That gets very expensive. So you got to add that cost. And then you truly do need to find a purpose. Like, what are you going to do with your life? Because you're not going to say don't play video games. That's going to get boring pretty quick. You can certainly travel a lot, and there's people that do that, but you still need to have that purpose, because traveling aimlessly is probably one of the hardest things to do. Because where do I go next? Well, how much can I afford? What can I do? Why am I going these places? So you can definitely do that as well. So you kind of need to basically put as much weight in retirement as you can. Then find a methodology, either annuities or side hustles on occasion, just to fill the tank of gas, something like that, to then start planning for your retirement. Because now you're not planning for 30 years retirement, which has already now become very difficult because we live longer. Plan for 60 years of retirement. And that can be hard to do because you also got to do the inflation calculations too. So if you're saying, okay, at 40, and we're still assuming inflation's crazy right now, about 2.25% inflation, what's that going to look like when you're 94 years old? I mean, how do you want your life to look like? I know it's a very long time away. So that's why you see people kind of say, hey, find a job you love. You don't work a day in your life. I kind of now see that. Granted, I work 60 hours a week at least at this point. So you got to kind of figure that out yourself too. And it's a very tough conversation. It's a very tough way to do it. But fire folks, tons and tons and tons of money away.
Yeah. So, well, what advice would you give to someone so they can calculate a date? Like, what are the numbers? What are the metrics they have to look into so that they know that number that they have to hit so that they can be financially free at least?
So that's a lot. So here's how I do is my process that I work with folks through, because no matter what, it's still kind of the same thing, just depends on the amount of time. So the numbers that you need to know are: one, how long are you going to live? So statistically speaking, we're looking at about 95 or so for women and about 93 for men.
Is that in the US or that in general?
That's for the US. In general, I believe it might be a little shorter, but we're also seeing now trends. I believe this generation is the first generation of a downtrend in life expectancy. So that's going to be interesting. We'll see what happens 20 years down the road. So you got to kind of plan backwards from there. So we're going to live that long. Well, how do I want to live my life? Do I just not want to work? Do I want to travel? Do I want to live a life of purpose? I want to get back. How do I want to live my life? Because that's going to then say, which direction do we go? Because what number do I need? If I want to travel, well, I obviously need a lot more money than if I just want to hang out on a farm or a ranch or just camp and hike. So we got to figure that part out. Then from there, using inflation, what other goals do we have out of life? How much am I willing to spend on those goals? Okay, cool. Then, okay, what's a rough number that I need to be at? And then how do I build in contingencies to protect myself? So let's say, for example, let's go back to the 4 horsemen. You have all the savings you need. You have, let's say, 20 years of savings, and you get lucky and you find a, I don't know, bond or something, or an annuity that pays out enough interest to where you're going to pull all your principal down to the day you die. So you get lucky. Well, what happens if you get sick? Do you have any protection there? Are you covering that? No. Okay. Well, what about a car? Are we going to use a car to travel around? Do I need to buy a new car? How much do I maintain it? So you need to find your current expenses, and then also the fire thing is it's a good concept. Candidly, I plan on working the day I'm 70 just because I love it.
Yeah.
So it's what do you want? It's kind of the question.
So you mentioned kind of having enough saved up. What about cash flow? Because a lot of times it's a lot easier to hit a cash flow number, especially with some of the investment strategies that I talked about on the show, like Airbnbs, short-term rentals, things like that. It's a lot easier to get a good amount of cash flow going than it is to get a large portfolio of, maybe index funds or whatever the case may be, maybe bonds. It's a lot easier to get that cash flow number. So what's your kind of advice there for, instead of trying to save up to have an X number, just get enough, whether it's rental properties or dividends, to get enough certain number of cash flow? What's your advice there?
Yeah. So cash flow is king, right? So if you have the cash flow, and let's say I am consistently making $10,000 a month, just round numbers, consistently bringing in $10,000 a month, and I net out, let's say $5,000 a month outside of expenses. Then you need to be diversified in your cash flow. So for example, let's say you have a ton of Airbnbs. What is stopping Airbnb from raising the rates they charge you? You lose cash flow. Now, if you own the property, you do have an advantage that you own an asset. You can always sell an asset to buy another one. You can adjust for it. Or just simply, you design a process where you cut your expenses and you run the management yourself. So how do you do that? Then from there, also you need to start looking at other places too. So we talk about how it's hard to save up. The beauty of the investment side of the world, and I like all of it, don't get me wrong. I like the real estate. But the beauty of the investment side of the world is you have liquidity. You can always leave that cash, not always, but generally speaking, pretty quick. So you need to have a diversification in how you're getting your cash flow. You can build it to where you have particular mutual funds, ETFs, or certain stocks or bonds pay out on, let's say, the 1st of January. There are a handful that pay on the 1st of February, March, etc. Then you have your rental income coming in. So you can certainly have that cash flow. And then it just comes down to managing your expenses effectively. And that's where you kind of start running a business. And if you think about it, then you got to start figuring out, okay, I still want to live my life and goals, still saving for retirement, because we're going to get old at some point. At some point you don't want to deal with the property. So then what do you start doing?
Yeah, definitely. And so we've kind of been talking about a lot of things with more so long-term glasses on, thinking about, where we end up, how the life we want to live. What could we do to get started today? Like someone 20 years old, they have a job, maybe working 30 hours a week or part-time, whatever it may be. They might have some classes on the side here and there, probably still with their parents. What could we do today to get started moving forward? Whether it's financially independent, retire by 40, maybe it's financially free by 25. Like that's where I'm trying to strive for. Maybe it's working till we're 70, but doing something we love. Maybe it's chilling on a beach, sipping Mai Tais, whatever it may be. But despite what the goal is, what can we do today to move forward so that we could, wherever our goal may be, that we can get one step closer?
Absolutely. So this is how we start off my meetings with all my clients and prospective. These 3 questions, I think you need to ask yourself these 3 questions first to then understand the next step. So what I do is I ask folks, hey, if you won the lottery today, enough money, never have to worry about it again, what does life look like? Then ask, hey, we're in the same situation, and because we're doing so well, we have great doctors. And the doctor says, hey, you have 5 to 10 years left to live. What would you do a little different? Then go one layer deeper. I say, hey, doctor came back to you and goes, you know what? We missed something. You have 24 hours left to live. What do you wish you did? What do you wish you would have done differently? And understand where you are on that point. And then from there, understand the direction of the long term, because you need to know why you're now putting out a budget, pulling up with bank statements. Where's my spending going? Now I know I have a rough idea of my budget, my current spending. Well, now I know where I want to go. Cool. Here's current state. What do I need to adjust to get there? Because if you don't know why you're doing anything, what's the point? So that's awesome. The first things I would do is understand where you want to go with those 3 questions. Put together a budget. Use any apps you can. Go online. There's free stuff everywhere. Put it together. See where your spending is going. Then, based on what you want to do about your life, you have goals. Okay, what's a goal going to cost? Figure it out. Have some fun. I use jameslist.com. It's a great website to go look at crazy real estate. That's my goal. And so I go there and I say, cool, this house costs this much. Okay. Well, now I know the cost of that. I can work backwards from there. I know why I'm working backwards because of the questions I ask myself.
Amazing. So James, you've been dropping a bunch of gems. We've been able to talk about how to build that emergency fund. That's the number one thing for anyone to get started is wherever you're at, build that up so you have some wiggle room, right? We don't want to be living paycheck to paycheck. We want to have some cushioning. Then from there, whether it's protecting your income or whether it's getting out of that credit card debt, make sure that you always know that preventative is always better than working from once you already get behind. It's a lot easier to never get into debt than it is to get out of it, right? So make sure that, as you said, watch where our money is going, watch where our spending habits are, and then finally start saving now, right? Investing, whatever it may be, but invest now so that we can be prepared for our future so we can have that retirement money, right? And so where can we get connected with you? Where could we find you at so that we could get more information like this where we can be better prepared, be better planned for whatever it may be, whatever goals we may have?
Yeah, there's a lot of ways to do it. So my website is woodallwealthmanagement.com, WOODALL. My LinkedIn, I'm on there too. Just under James Tyler Woodall. In fact, I actually just did a post the other day about if you won the lottery, what the first 10 steps you should do. Those were kind of fun to talk about. So that's probably the best 2 places to find me is just my website and LinkedIn. I'm slowly figuring out social media. I just haven't done it yet.
All right. And so now it's time for our final 4 questions, the way we end every podcast episode. Number 1, what is the most impactful lesson you learned in life?
A bias towards action. Everyone's got great ideas, but very few can execute on them.
What is the most admirable trait a person can have?
Honesty. That's what you need. It makes the world go round.
If you had to change someone's life with one book, which book would you recommend?
I like a book by Tim Ferriss, Tools of Titans. That's the book that started me on this journey. It's got some great advice and tidbits in there. That's great.
And what is the legacy that you're trying to leave behind?
Building wealth doesn't have to be complicated. You just have to be honest with yourself and always have to be willing to ask for help. And once we can do that, we can make, it sounds so corny, but we can actually make the world a better place.
I know. I always said that if we can all become financially literate, we don't have to be crazy millionaire entrepreneurs, but if we could all just be financially literate, this world would definitely be a much better place. But James, it was a pleasure. It was an honor to have you on the show. I thank you for taking the time to come prepared, come with some nuggets that we could apply no matter where we are in our journey right now. And I just thank you for taking the time today to be here and have this conversation with me.
Absolutely. It's been a blast. I hope I have you back on. I can't wait.